So this is the workshop on the lowdown on annuities. And my name is John Segraves. I'm a senior advisor here with Wright-Patt Credit Union and just celebrated my 10 years here with the credit union. So I work out of our corporate offices. I don't really cover any of the member centers. I mainly have my book of business, my clients that I service and just try to provide a deeper level of service to those clients. But if you have questions or anything, like I said, use the chat box and we'll try to address those at the end. I often hear folks say when they come in, that Clark Howard, Dave Ramsey, my brother, my coworker, fill in the blank, says to avoid annuities. And I'll be the first to say that annuities are not for everyone, but that doesn't mean they are not for anyone. And Clark Howard and Dave Ramsey, they're trying to speak to a mass audience and apply financial principles to everyone in that audience, assuming everyone's comfortable with the same level of risk. And one thing I know for sure is financial planning and investment management is a very personal endeavor. And the same risk and strategies can't be applied to every person who comes through my office doors. So not all annuities are created equal. They can be used to accomplish different purposes. And today we want to pop the hood on annuities and give you some insight into the world of annuities and how they might fit into your personal financial plans. So let's start with what is an annuity? An annuity is an insurance-based contract between you and the issuer or the insurance company. And this is basically how an annuity works, okay? You pay premiums with after-tax dollars, and we're talking in this case about non-qualified funds, meaning non-IRA dollars, okay? But you pay premiums or make deposits with after-tax dollars. The insurance company invests the money for you according to the strategy of that particular annuity that you're using. Any earnings will accumulate tax deferred, and at some point the issuer pays out the principal and the earnings to you or your beneficiaries, okay? And those earnings are taxed as ordinary income when they're distributed, okay? Now, there are generally four parties to an annuity contract. The owner is usually the one who purchases the annuity, pays the premium, and names the beneficiary in the event of death. The owner can make withdrawals from the annuity or they can surrender the annuity. And it's generally the person who receives income payments. There's a couple different ways of how to receive income from an annuity. Old annuities, the only way to receive that income was through annuitization. And that's basically the idea that you're relinquishing control over the assets in the annuity to get a lifetime income stream. With more recent annuities, you can do annuitization, which I'm generally not a huge fan of. We'll talk about that in more detail later. But with more recent annuities, you can utilize riders and specifically living benefit riders that allow you to maintain control over the assets, but still have some level of lifetime income, okay? Again, we'll get into income options later on. The second party to an annuity is what's called the issuer. And the issuer is generally, it's an insurance company, and they accept the premium payments or the deposits. They invest them according to the different strategies of that particular annuity. and then they promise to pay whatever benefits the annuity contract stipulates, okay? So those benefits might revolve around income guarantees, principal protection, or enhanced death benefits, okay? The annuitant is basically the person whose life the annuity is based upon, and it's when it's used when calculating income payments for either the annuitization income or income riders. Typically, the annuitant is also the owner of the account, but not always. And then finally, the beneficiary name is named by the owner of the annuity, and they're going to receive the annuity proceeds if the owner dies before annuitization, or they'll receive the remaining benefits if applicable at the time of the owner's death. So why might someone consider purchasing an annuity? I think there's a few reasons. The simplest thing is that they gain tax deferred growth on non-qualified funds. So we're talking about dollars, that may be sitting in checking, savings, money markets, CDs, maybe non-qualified brokerage accounts where they're taxed on dividends and capital gains in that account. By purchasing an annuity, those funds can grow tax deferred. They may be looking to save for a specific goal like retirement or legacy, or they want to use a particular growth strategy. Seeing a lot of this right now with the volatility that we're seeing in the market, okay? Annuities can provide another source of retirement income, secure retirement income, much like funding your own pension, so to speak. So as pensions are going by the wayside, folks still want a level of secure income, and annuities are a way to accomplish that. Touched on this briefly, to either hedge market risk or use a segmented approach. So you can use annuities as more of a preservation structure where you might have higher upside potential than fixed rates, but no downside risk. You might have annuities that provide buffers, so you get to participate as the investments go up, but there may be some buffers on the downside that give you some protection where you're not going to lose money unless the investments are past the buffer. So for example, if there's a 10% buffer or a 15% buffer, you've got a layer of protection and won't lose money until the investments are down more than 10 or 15%, whatever the buffer is. Age gaps. When there are large differences in ages between spouses, that can be a good reason to use an annuity. There's a 5-year difference between my wife and I, and women tend to outlive men on average by about 5 years. So if I retire at 65 and my wife is 60 and she outlives me by 5 years, personally, I only have to get 20 years out of our nest egg. If I live to age 85, she'll need 30 years from our nest egg if she lives to be 90. Okay. So annuities can be a way to provide, again, secure income for a longer period of time, specifically in this case when we're talking about age gaps. Okay. In-service rollovers. So those folks who are 59 and a half and still working, maybe they have a 401k or they have some lump sum options from their pension. They can protect the income that those retirement assets will eventually provide by doing an in-service rollover into an annuity at age 59 and a half or later. The income and savings provided by an annuity may help you remain financially independent, especially if you need higher withdrawal rates that are beyond 3 and 4% a year. Okay. And again, we're gonna spend some time on this later on. But if your income needs require you to take withdrawal rates, at 5%, 6%, or 7% of your balances, then using an annuity is something that you should consider. So, like I said, we'll go into more detail on some of these in the upcoming slides. The thing we're going to talk about first here is really just the difference between taxable growth and tax deferred growth. And this is an illustration of the advantage of tax deferred growth versus earnings that are taxable every year. And so in this case, we're going to assume that someone makes a lump sum investment of $10,000 that will compound annually at the end of the year. And this person is in a 28% tax bracket. And we're also going to assume a growth rate of 7% each year. So if that person had invested that money in an alternative that's taxed every year, well, in 30 years, they would have accumulated a little over $43,000 after taxes. Okay. But if that money was invested in a vehicle like an annuity that allows tax deferred growth, in 30 years, they would accumulate $76,000 more, than they had earned investing in the same account for the same length of time in something that's taxed annually. And that's basically because the money that's going to keep taxes, that's going to taxes keeps compounding. And as Albert Einstein is reputed to have said, compound interest is the greatest mathematical discovery of all time. So while annuity earnings do accumulate tax deferred, they are taxed on the back end as you're making withdrawals. Okay, they're subject to income taxes on the back end. Of course, annuities aren't the only choice that offers tax deferred growth. There's 401ks, IRAs, things of that nature. But you can also use annuities to invest your IRA dollars into as well. And you're not getting double tax deferred growth. There's no such thing as that, but you may like the investment strategies or some of the guarantees that annuities might provide for you as part of your retirement plan. But this is just an illustration showing how tax deferred growth is generally more efficient than taxable growth over time. We also talked about maybe using annuities as income sources. Okay, so this is just kind of looking at an example where we're starting to talk about withdrawal rates. And if someone has $500,000 and they're going to take a 4% distribution rate, that would basically provide them $20,000 a year of income. But what if you had an unexpected emergency where you needed to take an additional $20,000 for that emergency? So you've now taken $20,000 for regular income and another $20,000 for an emergency, and that $40,000 as a total withdrawal now becomes an 8% withdrawal rate for that year. Okay, and that is an exceptionally high withdrawal rate to do. And so using annuities can maybe provide you with a higher level of withdrawal rate than the basic 4% and allows you to maybe maximize income off of your assets. Also mentioned about using a segmented approach and using annuities to kind of manage risk. And so this is an example where someone might have a $500,000 nest egg, and they want to position part of it for legacy, part of it for preservation, and part of it for income. Okay, so by taking a segmented approach, you could actually position $334,000 at a 6% withdrawal rate in an annuity, and it would still provide that same $20,000 a year. okay, as you were getting with a 4% withdrawal rate off of 500,000. You can then use the other 600, use the remaining 166,000 for other purposes like legacy or lump sum distributions. Okay, so this is where you can begin segmenting your portfolio for different purposes. All right. When you want to protect your income from market losses as you approach retirement, you can use a variable annuity for the stock position of the portfolio, and where you have protections or riders in place with income guarantees. And you can be more conservative outside of the annuity through other investments with the remaining part of the portfolio. Okay, so again, when you use an annuity as part of an overall strategy and structure things accordingly, it's a way to manage risk, mitigate market risk, defer income risk. There's a lot of different ways to really use annuities as part of your overall portfolio. The next screen basically is a study called the Trinity Study, and we're going to spend some time on this because this is where the idea of withdrawal rate from your portfolio in retirement is really, really important to make sure that you don't live your assets. So what this chart is basically showing is that let's say someone had a $100,000 account. A 3% withdrawal rate would provide $3,000 a year. 4% withdrawal rate would give $4,000 a year, and so on. You can't expect to take a 10% withdrawal rate from your account and expect that money to last 20 to 30 years. It's using a conservative portfolio. I mean, that money is not going to last when you're taking that high of a withdrawal rate. So what this chart is basically showing, it's showing the likelihood of how long your assets will last based upon the withdrawal rate that you're taking in the investment portfolio that you're using. So, for example, if someone was invested in, let's say, a 50% stock, 50% bond portfolio, and they were looking at taking a 7% withdrawal rate or $7,000 a year off of a $100,000 account, well, at a 50-50 portfolio, there's only a 79% chance that that money is going to last for 15 years. There's a 55% chance that it's going to last for 20 years, 37% for 25 years, and 17% chance that it's going to last for 30 years. Okay. So this is where withdrawal rates really become important, along with how the portfolio is allocated. So, generally speaking, the rule of thumb is if you're taking a 3% to 4% withdrawal rate, for the most part, those are pretty high probabilities that money is going to last, 15 to 20 years. If you get real conservative and doing everything in 100% bonds at 4%, you only have a 20% likelihood that that's going to last for 30 years. But you start getting into 5, 6, 7% withdrawal rates, I would say that's where you probably need to be looking into annuities and at least researching whether or not they might be a good part of your portfolio. 8, 9, 10+% withdrawal rates. I mean, I wouldn't even go there, quite honestly. I mean, unless there's a terminal illness situation or just something that is this money's only got to last for 10 years or something along that line. I mean, the higher withdrawal rate that you're taking from your portfolio, the more strain that you're causing on the portfolio, and that income risk could cause you to outlive your assets, and we certainly don't want to see that happen. Next thing we're going to talk about is a scenario where Jim is 65 years of age and he has a $500,000 account, and he's basically invested in an index fund, which is just going to mirror, in this case, whatever the S&P 500 does. and he plans to withdraw 5% a year, so 25,000 a year. And what you're seeing here is that in scenario A, what actually happened in the market from 2000 to 2017, the market started on a downward trend. It was down every year from 2000, 2001, and 2002. And therefore, as Jim was taking withdrawals from his portfolio, by the time he got to age 83, he only had $20,000 left in his account. Okay. What scenario B is doing is it's looking at the exact same returns over the same period of time. It's just flip-flopping the order that those returns came in. So in scenario A, where he started out with a negative 10% return and then negative 13, in scenario B, he's ending with a 10% return. He's ending in a down market and starting his retirement in an up market. This is just for hypothetical purposes. So what's happening here is because he started in an up market, look at the difference in the balance of his account at the age of 83. Instead of 20,000, he had 477,000. Okay. So what this is illustrating for you, keep in mind that in both scenarios, the average rate of return is the exact same at 4.95%. So it's not always about the average rate of return in a portfolio. It's about the order that those returns came in. And so the reason I show this to folks is because in scenario A, he probably should have looked into using an annuity, because if he outlived his assets and lived to age 84, 85 and exhaust his assets, he would still get that same $25,000 a year through an annuity, even though he's exhausted the account. Okay. Now in scenario B, he didn't need an annuity. His investments performed well in the early years, not so well in the later years, but with the balance of his account at age 83, I mean, that account's still going to provide another 16, almost 20 years of income for him. The problem is that when he's starting retirement at age 65, he doesn't know how the market's going to play out, right? I mean, we see this in hindsight, but you don't know how things are going to play out starting retirement. And so you've got to make these decisions early on. So again, in scenario A, he should have probably considered an annuity. Scenario B, he didn't need one. The average rate of return is the same at 4.95% in both scenarios. And the thing that this is not accounting for in either scenario is inflation. Okay. And we all know that inflation is very high right now. There is no inflation adjustment on his income. And so the same 25,000 that he's taking at age 65 is not the same 25,000 that he's getting at age 83. Okay. And so ideally you want to have some type of inflation adjustment in your income scenario at retirement. What's a little bit scary about this is with where we are in the market these days, someone who's retiring now or in the next couple years, they could be entering into more of a scenario that's similar to scenario A versus scenario B. Okay. And if you start taking withdrawals in retirement while the market is going down early on, it could cause you to deplete those assets sooner on the back end of your life. Okay. There's different types of annuities. And the first thing I want to point out here is we're talking about the accumulation phase of annuities, where you're mainly just trying to grow money. Okay. We're not talking about the distribution phase. There are mainly three different types of annuities. There's fixed annuities, which are much like a CD. I mean, you're signing up for a term and you're getting a guaranteed fixed rate for the duration of that term. There's index annuities, which give you higher upside potential, but still no downside risk. And then there's variable annuities where you're taking on market risk through either a portfolio of stocks, bonds, alternatives, commodities, precious metals, things of that nature. So fixed annuities will generally be a single deposit into the account. Variable annuities will usually accept more than one deposit. And then index annuities just depends upon the platform that you're using. Some of them are single deposits, most of them are single deposits, but there are some out there that allow multiple deposits into. Fixed annuities will provide you with a guaranteed rate of return. Like I said, that fixed rate is generally locked in for the duration of that account. Index annuities, for the most part, don't provide a guaranteed rate of return. What they provide is the guarantee that you won't lose money, okay? And then variable annuities certainly don't provide a guaranteed rate of return because you're assuming some level of market risk. Fixed and index annuities generally do not have any cost associated with them when it comes to mortality and expense charges, okay? Variable annuities will have what are called M&E cost, okay? If you are signing up for optional riders, okay, usually fixed annuities do not offer riders to them, so again, no cost. Index and variable annuities can offer riders, and usually those riders will have some cost associated with them. Again, just kind of duplicating, that there are costs associated with the riders. Typically no investment cost with fixed annuities or index annuities. With variable annuities, there are costs associated with the investments. You can see, again, fixed and index annuities don't have any downside market risk. Variable annuities do. And as such, you should probably compare the rate of return from fixed and index annuities would be more of comparing those returns to CDs, where maybe you're trying to beat CD rates. Variable annuities should be compared. Those returns would be more in line with mutual funds and ETFs, exchange traded funds. How you get guaranteed lifetime income? Well, in fixed annuities, the only way to do that is through annuitization. Again, through annuitization, you're relinquishing control of the balance of the account to get that lifetime income. I'm never really a fan of that unless that's kind of your last resort to increase income. Index annuities, you can get guaranteed lifetime income through index and variable annuities through either the riders or through annuitization. Okay, so you have a little bit more flexibility with the riders in providing secure income. We're going to take a look at two basic annuities, fixed and variable. And there are many similarities in both how they work, but both will involve the same four parties that we talked about before. They have the owner, the issuer, the annuitant, and the beneficiary. Both offer tax-deferred growth. Both offer the freedom of discretionary withdrawals, subject to surrender charges. Both may be annuitized for income and distributions. And earnings for both are taxed in essentially the same fashion as they're taxed as income as you make withdrawals. There's some significant differences, though, between fixed and variable annuities. So, like I said, fixed annuities will guarantee that the principal you invest will be returned to you, and the issuer guarantees a minimum rate of return on your investment. Of course, all guarantees are subject to the claims paying ability of the insurance company. So similar to a CD with a fixed rate of return is our fixed annuities. This isn't the case with variable annuities. Variable annuities, again, there's no guaranteed rate of return. those returns are generally market performance based, okay? So there's no fixed interest rates as well. The investment choices are determined within the sub accounts of a variable annuity. And like I said, those are generally market driven. Fixed annuities will generally have no fees. Variable annuities will have fees associated with the riders, with the investments, with the M&E cost, and they can, get fairly expensive in cost when you're dealing with variable annuities. Okay. We're going to take a look at some of the differences between annuities versus 401ks and Roth IRAs. So again, when we're dealing with annuities in this scenario, we're dealing with non-qualified annuities. All of them will give you tax deferred growth, okay, which is good. Only 401ks and traditional IRAs are those contributions tax deductible, so they're lowering your income now as you're making your contributions and you're paying taxes on a lower level of income. Unlimited contributions, really only annuities will offer unlimited contributions. There are annual limitations in both 401ks and IRAs as to how much you can contribute into those accounts every year. So if you've got someone, if you're someone who is making 300,000, 400,000 plus a year, you're not going to be able to fund Roth IRAs or traditional IRAs, and you're only going to be able to put in about 24,000 a year into 401k plans. Okay. Annuities can be a place where you, sock money away that continues to grow tax deferred, and there's no limitation on how much you can put in there each year. Guaranteed death benefits. Annuities are typically the only place that you can get guaranteed death benefits. So if someone had invested $100,000 into an annuity and the market is obviously down this year, say 15%, and that 100,000 is now only worth 85, well, upon your passing, if you were to pass away and the balance of that account is 85,000, your beneficiaries may still get the 100,000 that you deposited into the account. You're not going to get that obviously with 401ks and IRA accounts. Required minimum distributions are only required to come from pre-tax 401ks and traditional IRAs. Okay. As far as tax on withdrawals, again, that comes from annuities. On the growth, you're taxed as income. And of course, on 401ks and traditional IRAs, you're taxed as income on those as well. Guaranteed lifetime income, annuities are the only thing out there that can provide, other than a pension. A pension is an annuity, by the way, so it's just an annuity that's done through an employer. But annuities are really the only thing that provide that guaranteed lifetime income. And all of them have fees on some level. Just they vary in range. Okay. Again, not all annuities have fees. I want to make that clear. Fixed annuities and index annuities typically do not have any fees associated with them. But when you're taking market risk, there will be fees on those variable annuities. Okay. As far as putting money into an annuity, the accumulation phase is basically the time period when you're making deposits into the account. And generally, there are a couple of ways that you can make those deposits during the accumulation phase. You can make a one-time deposit. That often happens when you're doing a rollover, or if you've got IRAs that you're transferring, or if you've got an old annuity that you want to transfer into a new annuity and maintain the tax deferred growth. That's called a 1035 exchange. Those are generally one-time payments into an annuity account. You can make a series of payments over time That's typically reserved for variable annuities, although there are some index annuities that will allow that. But generally, fixed annuities and index annuities generally are one-time payment options. Okay, not always, but generally. Annuities also are classified as either immediate annuities or deferred annuities. And these terms simply refer to when the distribution phase of the annuity begins. So immediate annuities will convert a lump sum deposit into an income stream, and they're typically purchased, with a single payment, and the distribution of that annuity usually begins within a year or less. Okay. A deferred annuity may be purchased with a single deposit, or a series of, multiple deposits. The distribution period begins sometime in the future, typically longer than a year or, down the road. However, you may be able to make withdrawals or partial withdrawals anytime, and we'll talk about that a little bit later. Like I said, payouts on deferred annuities will happen at some point in the future there. Okay. As far as with a fixed annuity, you put money into the account, to the insurance company. Your payments are placed in a general account where it earns interest. That rate of return is generally a fixed rate of return that's declared by the insurance company. Any earnings on the money that you invest grow tax deferred. You don't pay taxes on the earnings until you take withdrawal, and usually it's the growth that's going to be taxed first. There are different withdrawal options back to you. You can take these withdrawals periodically, or you can annuitize the contract, in which case you'll receive the same payments for a specific period of time. It could be, 10 years, 20 years, or whatever the case is. Could be for the rest of your life. Okay. Most annuities will provide a death benefit at your death, depending on what the account value and the payment options you selected. And so that death benefit obviously gets paid out to the beneficiary. Okay. Now, a variable annuity generally works much like a fixed annuity. The main difference is that you can invest premiums in a wider variety of investment choices, called sub-accounts, but you make those deposits into an insurance company. The money is invested into stocks, bonds, or a combination, some type of market portfolio. And then you basically take withdrawals from the annuity through a series of payments. Or if you haven't annuitized it, you can take it all as a lump sum withdrawal somewhere down the road. Okay. Variable annuities will typically offer a guaranteed death benefit that's equal to your deposits. So that again, if the investments are down upon your passing, it'll pay out to your beneficiaries at least the amount that you put into the account. Okay. So the guaranteed death benefit, is considered a form of insurance. So it's not surprising that both fixed and variable annuities can provide, guaranteed death benefits when you pass away. So if you die again before the annuity is annuitized, then your beneficiary will generally receive all the premiums that you paid in, even if the investment is lower than what you deposited. Obviously, that's going to be reduced by any withdrawals that you might make from the account. They're not going to pay you on the same money twice. Okay. If death occurs after annuitization, some payout options can continue payments to your beneficiary, but generally speaking, if you've annuitized, you've relinquished control over the assets within the annuity. And unless you signed up for like a 10-year certain or a 20-year certain, and you passed away before that certain period of time was up, those are really the only times that those annuities would pay out to your beneficiaries. Generally speaking, once you pass away and have annuitized the account, those annuities will not typically pay out anything to your beneficiaries. Okay. Again, as far as annuity fees and expenses, generally speaking, there's no fees with fixed or index annuities. There may be a contract fee like $25 a year or $50 a year. That's often waived, if you have if you maintain a minimum account balance. But as far as, M&E fees or rider fees, things of that nature, investment cost, fixed and index annuities typically do not have those fees. Variable annuities is, when you hear about annuities getting expensive, it's generally because of the variable annuities. They'll often have an annual contract fee. They have, again, what's called that M&E cost or mortality and expense charge. There can be rider cost associated with it. And then there's often sub-account cost as well, which are much like, mutual funds have cost associated with them too. So, sub-accounts will typically have investment costs that parallel the mutual funds. So again, if you're hearing, about how expensive annuities are, they can be. That's generally referring to variable annuities and not fixed or index annuities. Generally, you can take disbursements from an annuity in one of two ways. You might withdraw money at your own discretion, although there are tax penalties for doing so if you are younger than 59 and a half. Okay, so it has some of the similar rules that you might find in IRA accounts, where if you take withdrawals prior to 59 and a half, you might be subject to an early withdrawal penalty, so to speak. There's withdrawals can be taken either at regular intervals or, just kind of sporadically. You can elect at some point, like I said, to annuitize the account, where you're basically selecting a guaranteed income option. You can take withdrawals based upon specific riders. These riders, if they're income-driven riders, they typically do not require annuitization in order for you to get secure lifetime income. And one of the nice things with annuities is that you don't have, unless it's an IRA that's being invested in an annuity, but non-qualified annuities, you do not have required minimum distributions that you have to worry about. Okay. Again, that's only applicable on IRA accounts. So we're going to take a look here as to what happens when you annuitize an annuity. Generally, annuitizing converts your annuity or your assets in that annuity into a stream of payments. With a fixed annuity, the current value of your account is converted into a stream of guaranteed payments, and you'll receive those fixed payments on a schedule of your choosing. Okay. With a variable annuity, you can convert the current value of your account into a stream of fixed payments, just like a fixed annuity, or you can receive variable payments where the amount you receive will be dependent upon the performance of the investments, underlying investments within the annuity. So it can cause your income to increase if the investments are doing well. It can cause your income to decrease if the investments are not doing well. Okay. Once you annuitize, you usually cannot change your mind as far as relinquishing control over those assets. That's typically an irrevocable decision as far as annuitization goes. And we're going to look at some of the factors that might affect those annuitization payments. Okay. If you own a fixed annuity, the cash value of your account at the time of the that you annuitize will affect the amount of your payment. The larger the cash value of your annuity, the larger the payments will be. If you own a variable annuity and choose payout options other than fixed payments, then again, the performance of the underlying investments will affect your income from year to year. You might remember that the annuitant is the measuring life for the annuity. So often the gender and age of the annuitant will affect how much income annuitization payments are providing for you, okay? And the payout option you choose will also affect those annuitization payments. You know, are you expecting those payments for 5 years or 20 years or lifetime? Okay, so all of that, you know, factored in is going to have an impact on how those payments are made. The payout options that you generally have through annuitization, you can have payments for life. You can have payments for a certain specific period of time. It's called period certain, where again, you can select a 10-year, 15, 20-year period certain. You can have refund payments. Okay, so if you did not get all of your principal, some annuities will say, hey, if you had passed away before you got all of your principal back to you, you know, we'll make sure that your beneficiaries are refunded the difference. There's joint and survivor annuities. So, hey, this account is going to provide income for both you and a spouse upon your passing. So it's paying out income for 2 lifetimes instead of 1. Again, for variable annuities, you know, sometimes those payments will often be determined by how the underlying investments are performing within those variable annuities. So, you know, you might have some variable income options within those annuities as well. We've talked about annuity riders. Again, these do not require annuitization, but riders are generally safety nets or guarantees that might kick into play if the investments don't cooperate for you. Okay, so aside from the common features of each type of annuity that we've discussed so far, the insurance carriers will offer riders, and most riders are available at a cost, can be as little as 0.1% per year, can be as high as, you know, 1.5% per year. It just depends upon the nature of the rider and the insurance carrier. Okay. Fixed annuity riders might include waiving surrender charges if you had to get out of the account early. It might be called what's called a return of premium, where they won't allow that penalty to get into your principal. There can also be charges can be waived if you went into long-term care, if you were diagnosed with a terminal illness. Sometimes there's disability or unemployment riders that allow you to get your principal out without penalty to them. Common variable annuity riders are, you know, guaranteed income payments. There can be principal protection if the investments didn't cooperate. You know, they may pay out your principal back to you. And then there's lifetime income benefits as well, that, hey, this account will provide you a minimum guaranteed withdrawal amount. Even if you exhaust the balance of the account, the annuity will still provide you with lifetime income. Okay. Immediate annuities will often include access to the balance of the immediate annuity in a lump sum. It's called a commuted payout rider. This increase and also increasing payments each year to offset the cost of inflation. There can be cost of living riders with annuities, or you can have the assurance that if you don't live long enough to collect payments that are equal to your deposits, then the balance will be paid to your beneficiary either in a lump sum as a cash refund rider or in a series of payments, which is an installment refund rider. Okay, so again, these are all various types of riders that can be associated with annuities. Federal income tax consequences are essentially the same on fixed and variable annuities. The portion of any withdrawal that is paid out as growth, generally it's the growth that's going to be taxed on those accounts. So if you have 100,000 that grew to 140,000, that $40,000 is going to be taxable. Okay. Withdrawals are considered to be made on and taxes are considered to be made on earnings first. So in that previous scenario, if you've got $40,000 of growth and you need to take out a withdrawal for $10,000, well, that $10,000 is going to be part of the growth, so it's all going to be taxable. If you needed to take out $50,000, well, 40,000 of that would be taxable because it's the growth. The remaining 10 is your principal, which would not be taxable. Okay. In addition to income tax on the earnings portion, again, we talked about there could be an additional early withdrawal penalty if you're taking those withdrawals out prior to 59 and a half. That's very similar to IRA early withdrawals. Okay. These are just some disclosures on, information about variable annuities. They're long-term investments, they're sold by prospectus, that type of thing. When should you get rid of an annuity? I think this is something that's really important to consider. And in order to get rid of an annuity, the annuity generally cannot be annuitized. Okay. So there's several reasons to get rid of an annuity. If you initially planned to generate income from your annuity, but no longer foresee that need, then you may need to change annuities or leverage the funds for other purpose for like legacy or long-term care, maybe even survivor income. Okay, so if your goals change, if your purpose for the annuity has changed since you started it. You may be able to provide yourself with more income if you move from one annuity to another. Okay, so again, the annuity could not have been annuitized, but if you're using living benefit riders and your annuity is out of surrender, you might shop and see what some of the current market annuities are providing. Can you increase the level of income that it's providing for you? If you're paying for riders that no longer apply to your goals, you would want to probably change annuities to reduce cost. If your life expectancy prevents you from benefiting from the riders, for instance, if you're 75 years old and it's going to take you 20 years to get your account value returned to you through the income guarantees, you might want to get out of that rider or out of that annuity and look into something else. If you're 75 and it's only going to take you 10 years to get your account value returned, well, you might want to stay in the annuity. Okay. If your contract forces annuitization at a specific age, say at age 85 or 90 or 95, you would want to get out of that annuity before you reach that age. If you want to change growth strategies, or if your risk temperament has changed, if you want to change from being market driven to preservation oriented, again, risk temperament might be a reason that you change and get out of an annuity. If you want to start unwinding the tax deferred growth, okay, maybe you've got a lot of growth that's going to be taxable. A 100,000 account maybe has grown to a $300,000 account over a long period of time, and you want to start taking out $10,000 or $20,000 a year to just start unwinding the tax deferred growth so that you're not hit with all of it in 1 year. That might be a reason to get out of an annuity. If you want to lower your overall cost, again, there can be a lot of reasons or a lot of ways to reduce cost. It can be riders that you're no longer benefiting from. It can be changing from a variable annuity to a fixed or an index annuity. But again, if you want to lower overall cost, that might be a reason to get out of an annuity. Okay, so these are all things that you should consider as to reasons that you might want to change from one annuity to another, or just get out of annuities entirely. We're going to take a minute. I'm going to kind of show you part of what we do here at Wright-Patt is financial planning. And I've got a commercial here or a little, 3-minute video that kind of goes into some detail as far as the financial planning offerings that we provide. This may be something that you want to take advantage of to see where annuities or any other investment might fit into your overall financial plan. If you decide to exit out, I think there is a survey that probably has like 3 or 4 questions to it. Would only take a few seconds for you to complete that survey. Please take the time to do that. And then after this video, we'll come back and see if there's any questions on any of the material, and we'll try to answer some of those.
Life isn't static. Life changes, and it's important to be prepared for those changes. Welcome to Money Guide Pro, the groundbreaking financial planning software that sparks the important planning conversations and helps you create your own personalized plan for your life and retirement. The experience is simple. We start with the easy stuff, your personal information. Then move to the exploration of your personalized goals, which are the heart of a quality financial plan. Your goals are divided into needs, wants, and wishes. Not all goals are equal. This will help us prioritize what is most important to you: buying new cars, paying for college, providing care for a loved one. We'll address each of these and learn what is important to you and why. We also address those items you may not be thinking of. So it's important to include healthcare costs into your goals and discuss longevity to make sure you're protected. Next, we evaluate the resources you have available to fund your goals. We review everything from retirement income, pension and Social Security, to investment assets and insurance, or other assets such as a home, rental property, or business and stock options. Have liabilities. We can enter those too, and then view your net worth statement. We'll discuss risk and decide how much risk you're willing to take. You have one question: can I fund all my goals without running out of money? We provide an easy to understand result called the confidence meter, which shows you your probability of success. If you want to see more detail within the result, you can drill down into each individual trial or view a year-by-year breakdown. The plan may not end up in the confidence zone initially, so we'll make recommendations to get your plan into the confidence zone. One of the most interactive tools, the Play Zone, allows you to instantly see how changing some of your expectations, when to retire and how much to save, can impact your plan. We can also test the effects of risks outside of your control. Most importantly, your financial plan isn't static. It will adjust with you over time, and we will continue to review and make improvements as your life changes. You'll be able to view your plan through easy online access and see your dreams come into reality.
All right, guys. Doesn't look like there were any particular questions. I'll just kind of conclude with, not everybody needs an annuity. They can be a useful tool as part of certain financial plans. They can be a good way to manage risk in the market. So if you have annuity contracts that you're in and you want to see if it's time to make a change, it's something we can look at together. If you're wondering whether an annuity is right for your plan, we can certainly discuss that further. But that's my contact information. You're welcome to reach out to me if you need anything. But that concludes our presentation. Thank you.